The country's economic oxygen cylinder. What happens to the rupee, the market, and the economy if forex reserves run dry? Imagine this. One morning, the market opens, the rupee suddenly starts falling sharply, the dollar becomes expensive, oil importers begin to panic, foreign investors start pulling out their money, and on TV, one word keeps coming up again and again: forex reserve. To the common person, this word often sounds distant, technical, and boring. But the truth is, if a country's economy is a big house, then forex reserve is its emergency locker. If that very locker starts weakening, the first thing that shakes is the currency, then imports become expensive, then inflation rises, and then confidence in the market begins to crack. That is where the fear begins. Because as long as the reserve is strong, the economy has breathing space. But if that cushion starts wearing thin, how big the trouble can become? That is what matters most to understand. Foreign exchange reserve means those foreign assets held by a country's central bank, which can be used when needed for external payments, currency stability, and absorbing financial shocks. In India, this responsibility is handled by the Reserve Bank of India, or RBI. According to RBI's public data structure, India's forex reserve has four main components: foreign currency assets, gold, special drawing rights or SDRs, and the reserve tranche position with the IMF. So this is not just a pile of dollars. It also includes currency-linked assets tied to the euro, pound, yen, gold holdings, and IMF-related reserve claims. That very mix is what makes it usable, liquid, and reliable. Now the question is, why is this reserve kept at all? The IMF's reserve adequacy guidance clearly says that prudent reserve holding reduces the probability of a balance of payments crisis, provides stability in times of exchange rate pressure, and gives policymakers emergency breathing room. Put simply, this reserve is kept so that if there is panic in the global market, capital outflow, oil becomes expensive, the import bill suddenly jumps, or speculative pressure builds on the rupee, the country has the strength to respond. That strength is not just economic, it is psychological too. Because the market watches confidence just as much as it watches numbers. For a country like India, its importance becomes even greater because India depends on imports for many critical things, especially energy, crude oil, natural gas, electronics, machinery, industrial components, edible oils. There are many such things for which payment has to be made in foreign currency. If the reserve is strong, then both international suppliers and global investors remain confident that India can meet its external payment obligations. Reuters, citing RBI's March 2026 report, wrote that India's forex reserve is adequate to protect against external shocks. And, as of the 13th of March 2026, the reserve stood at around $709.76 billion, which covers about 11 months of imports and roughly 95% of the country's outstanding external debt. These very import cover and debt coverage numbers reassure the market. Now let us look inside the reserve a little. According to RBI-linked weekly data from January 2026, as of the 9th of January 2026, India's total forex reserve was $687 billion. Two things become clear from this. First, the reserve is not static. It changes week to week. Second, the biggest part of it is FCA, but gold too has now become a meaningful buffer. And if we talk about the record high, India's forex reserve touched an all-time high of around $705 billion at the end of September 2024. Later, there were ups and downs in it, but the broader picture remained that India built quite a strong external buffer over the past few years. That is why when people panic just by looking at the rupee-dollar exchange rate, they should also understand that the battle for the exchange rate is not fought empty-handed. A stockpile of reserves stands behind it. Now the core point, how does this reserve actually work? Suppose global uncertainty rises, foreign investors begin pulling money out of the Indian market, oil companies need more dollars, importers rush to buy dollars, and pressure builds on the rupee. At such a time, RBI can sell dollars in the market, which increases supply and eases some pressure on the rupee. This does not mean RBI fixes the rate every day or holds the rupee like a fixed peg. India runs on a managed float regime, but the reserve is used like a weapon to smooth excessive volatility. Reuters also wrote in a March 2026 report that amid record low levels of the rupee, RBI sold dollars to curb the currency slide. In other words, the reserve is not just money lying passively, it is an active defense system too. The second big impact of forex reserve is on inflation. Imported inflation is a very important factor in India. If the rupee falls sharply, imported oil, gas, electronics, chemicals and machinery become more expensive. Then their cost spreads into transport, manufacturing, fertilizer, power, logistics, and daily use products. That is why reserve is indirectly also a shield for inflation control. If the central bank is able to cushion extreme currency weakness, then the imported price shock can be softened to some extent. That is why it is a mistake to think of Forex reserve as just a balance sheet item. Its impact reaches the common person's diesel bill, airfare, mobile price, and household inflation. From the markets and foreign investors' point of view, the meaning of reserve is even bigger. When a global fund manager invests money in a market like India, he does not just look at GDP growth. He also looks at how much external buffer this country has if panic hits the world. A strong reserve means the risk of a currency crash is relatively lower. The possibility of a sudden payment crisis is lower, and the perception of sovereign stability is better. That is why a sharp fall in reserves often becomes a negative signal for the equity market, the bond market, and the rupee. All three. For the investor, a weak reserve means that in the event of a shock, the central bank's firefighting capacity may be limited. For trade and industry, its importance shows up in a different way. An importer does not just need today's dollar rate, he also needs predictability for the next few months. If the reserve is healthy, currency swings appear relatively manageable, hedging becomes easier to plan, and supply chain contracts can be made with more confidence. But if the reserve is weak, uncertainty rises in the market, hedging costs can go up, suppliers may demand stricter terms, and margins in import-heavy sectors can get squeezed. This can directly affect oil marketing companies, aviation, chemicals, electronics assembly, pharma raw material chains, and machinery-dependent manufacturers. After all, business needs visibility before growth, and reserve is what strengthens that visibility. Now let us come to that hypothetical but very important question. What would happen if a country's forex reserve were to run out completely? The very first impact would fall on the currency. RBI's ability to support the rupee by selling dollars in the market would almost disappear. In such a situation, the rupee could fall sharply and in an uncontrolled manner. A currency crisis often begins exactly here. People start losing confidence in the domestic currency. Importers begin panic buying, capital flight accelerates, and the exchange rate enters a disorderly zone. The IMF's reserve adequacy framework emphasizes avoiding exactly this kind of balance of payments crisis. A situation like reserve exhaustion means the country has become exposed in front of its external obligations. The second major shock would hit import payments. Think about it. An economy like India has to regularly import crude oil, LPG, LNG, electronics, and many industrial inputs. If the reserve becomes extremely weak or runs out, international suppliers may begin to fear whether payment will be made on time at all. Then either strict controls may have to be imposed on imports or emergency financing may have to be found, or payment terms may become much more expensive. In such a situation, pressure could spread to petrol, diesel, cooking gas, electricity costs, transport, manufacturing, and even the food supply chain. This could make inflation explosive. And when energy inflation rises, its shock spreads across the whole economy. The third impact would come on growth. If imports become expensive or restricted, industry's production costs will rise. If the central bank sharply raises rates to protect the currency, borrowing will become expensive. If the government has to go to an institution like the IMF, then things like policy tightening, fiscal restraint, import controls, or structural conditions may come into play. All this can slow down economic activity. In other words, forex reserve exhaustion would not just be a currency problem. It would become a growth problem, an inflation problem, an employment problem, and a confidence problem all at once. History shows that many countries have seen this same cycle during balance of payments crises: currency crash, inflation jump, austerity pressure, and economic slowdown. The stock market's reaction in such a situation can be very brutal. Foreign portfolio investors usually take currency risk and payment stability very seriously. If they feel the reserve is dangerously low, they can pull out money very quickly. That can trigger heavy selling in the equity market, push up bond yields, and create additional pressure on the domestic financial system. The market is not scared only by current earnings. It is also scared by future convertibility and capital safety. That is why a strong reserve often acts as a silent support system for market valuation, while a weak reserve can become a trigger for sentiment collapse. Now, it is also important to understand one practical distinction. The reserve has fallen somewhat, and the reserve has run out are two very different situations. India is not in such an extreme situation right now. In fact, by March 2026, RBI itself said that reserves are adequate against external shocks. The January 2026 level of $687 billion and the March 2026 level of around $710 billion point not toward any immediate crisis, but toward a strong buffer. So this topic should be understood not as panic, but as preparedness. The purpose of this discussion is not to say India is in danger. The purpose is to understand why a strong reserve is necessary and how much risk rises without it. That is why many economists call Forex reserve the country's economic insurance. Just as keeping an emergency fund at home does not eliminate life's uncertainty, but increases the ability to absorb shocks, in the same way, at the country level, reserve acts as a shock absorber. It provides import security, helps protect the currency from extreme volatility, boosts investor confidence, strengthens the credibility of external debt servicing, and buys policymakers time. Without reserve, the economy suddenly becomes vulnerable. With a strong reserve, that same economy can absorb shocks and gradually move back toward normalcy. So if someone asks why Forex reserve is so important, the answer is very simple. because it is not just a stock of dollars, it is a backup system for national stability. It protects the dignity of the rupee, preserves the continuity of imports, limits inflation shocks, gives confidence to markets, and provides firepower to the central bank during crises. India's latest numbers show that the country currently has this cushion, and a fairly strong one. But this very strength also teaches us that reserves should not be seen merely as a headline number. It is the economy's unseen muscle. As long as it stays strong, the country has headroom in front of the outside world. And if it ever weakens, the first thing to shake is confidence. And in an economy, there is no currency bigger than confidence. If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.